Hi, everyone. I'm Mike Pacito with IM Global Partner. Thanks for joining our monthly update on the IM Global Partner DBI Managed Futures ETF strategy, ticker DBMF. I'm joined by Andrew Beer, co-founder of Dynamic Beta Investments and co-portfolio manager of DBMF. He'll be doing the heavy lifting today, talking through 2022 performance, some trades and current positioning, while providing more color on the strategy and the investment landscape in general. I think you're going to find this to be time very well spent. Let's get right to it, Andrew. I'm going to hand it off right here to you.
So thank you very much, Mike. And by the way, Happy New Year to everyone. And thank you in advance for taking the time to listen to this short presentation. I'm going to turn off my camera so it doesn't clutter up the screen, but you'll obviously hear me talking. So Mike and I are going to be doing these every month. And our hope is that you're going to find the information valuable, not just to understand performance and its drivers, but also to highlight some of the themes we're seeing and maybe offer some talking points to address client questions. So before we get into the slides, though, I'd like to remind everyone that DBMF performance is always net of fees. And of course, past performance is not indicative of future returns. So now to the first slide. First of all, what a year. We were up modestly 0.4% in December and avoided the equity market drawdowns. But more importantly, for the full year, DBMF was up 23.5% on an NAV basis, over 350 basis points ahead of the SocGen CTA hedge fund index. So as a refresher to everyone, our goal is to outperform the index by replicating their pre-fee returns with a simple portfolio of the most liquid futures contracts, and then keep our trading costs as efficient as possible. So on the macro front, the inflation trade was actually quite contrarian from early 2021 until sometime in August or September of this year. And while, as you may recall, a few macro legends like Stan Druckenmiller called it early, most strategists kept calling for it to be transitory. And then when it wasn't, they started betting on a policy mistake and then pivot by the Fed. On the managed futures front, funds picked up on the inflation trade in 2021 and rode it until unwinding some of the elements in November of this year, of last year. So basically, DBMF ended up picking up on that and benefiting from it. On the attribution front, the inflation trade played out across markets. We saw broad-based gains in currencies, rates, and commodities, but lost money in equities. And interestingly, this pattern lines up with some analysis that we did of how managed futures funds generated 20% plus returns during the GFC. And it really wasn't about shorting equities, which get incredibly volatile with these violent bear market rallies, but rather about making money in currencies and rates where the trends tended to be steadier. So at any rate, this is what we mean when we talk about how regime shifts create more opportunities for managed futures funds. You tend to get more trends, and sometimes they go on for a lot longer than humans expect. So our positioning today is quite bearish, if not the full-throttled inflation bet from over the summer and early fall. And to remind everyone, the funds that we track build positions based on what has happened and a belief that some of those trends will continue. It's very different from, say, the macro trader who tells you what inflation will be in a year. As such, these characterizations are really our interpretation of what kinds of macro events will impact the portfolio. And remember that these positions can change month to month. But through that lens, we would stand to benefit from rising rates, further geopolitical issues in Europe and emerging markets, think China, continued outperformance of value versus growth, and potential supply shocks. And with that, let's turn to performance since inception. So the title of this slide is Stocks, Bonds, and Managed Futures. That's a term we coined to describe our thesis that managed futures is the logical third leg of a portfolio of stocks and bonds. The chart shows the performance of DBMF against the S&P 500 and the Bloomberg Aggregate Bond Index. The timeline starts in May of 2019 when DBMF was launched. As you can see, since inception, DBMF has outperformed both stocks and bonds. But the key is that the performance is concentrated starting in early 2021, the moment when we began this grinding regime shift from a world of low rates to one of inflation, monetary tightening, and rates normalization. In the right column, we highlight some statistics. DBMF has returned 12.2% per annum, over 350 basis points ahead of the SocGen CTA hedge fund index, and gained over 52% on a cumulative basis. From a diversification perspective, though, the key is that DBMF has had a negative correlation to the S&P of -0.2 and delivered over 13% a year in alpha. That's jaw-dropping. I'm just not aware of an ETF, let alone mutual fund or the majority of hedge funds, that has such powerful and positive diversifying benefits to a portfolio. One sort of interesting thing when you look at this chart is if you go back to the beginning of 2021, the S&P, really since the inflation trade started, the S&P is actually up over that period of time. Had a huge run up in 2021 before people sort of realized that the Fed was really serious, but then gave back 18% this year. So the first shoots of inflation really haven't impacted equities nearly as much as it has bonds. And so that's really where the real action has been. In DBMF, most of the early adopters correctly saw the strategy as one that could capitalize on rising rates and hedge their existing bond exposure. And as you can see in the chart, the ag actually rose in the low teens in the first year and a half after we launched, but then has gone through a grinding decline since then. So DBMF was actually long treasuries during the easing in March 2020, but gradually flipped to short as rates started to rise. Therefore, it's not surprising that DBMF has had a negative correlation to the ag of 0.5 since inception. So one obvious question is what the future holds. Obviously, no one knows. But from our perch, we'd make 2 points. First, we think it'll take a lot longer than a year to work through the excesses of the extreme monetary easing and fiscal profligacy of the last decade. Second, we're seeing some research that stocks and bonds tend to be positively correlated when rates are above 4%. And that, I think, is a frightening prospect for allocators whose portfolios are built on the assumption that they're not. Both those points, we think, argue for inclusion of managed futures in literally every traditional portfolio. We're simply not aware of a strategy where you can say that it's had zero correlation to stocks and bonds over 22 years and hit the trifecta of strong gains in all three major regime shifts. Hence, that's why we use this term, and we think you'll be hearing a lot about stocks, bonds, and managed futures this year. Now, let's go to the next slide and talk specifically about 2022. So this slide shows the year-to-date performance of DBMF and the SocGen CTA index against many other asset classes. I'm not going to spend a whole lot of time on this chart because I think we all know what a tough year it was, but I do want to highlight a couple of small points. The first is really that a lot of the old playbook on inflation really didn't work. If you look somewhere in that category that says fixed income, you'll see that tips were down 12%. And then if you move to the right, you can see traditional diversifiers, some of which have been used as inflation hedges. Now, yes, commodities worked very, very well. They're up 26%. But gold was flat. REITs were down 27%. Liquid hedge funds were down 6%. And then Bitcoin, the newest entrance to the inflation hedge game, was down 64%. So the point of this slide is really to highlight the argument that a friend of mine said about owning managed futures back in 2008 when it felt like everything had a correlation of one on the downside. And he said that it was a beacon of green in a sea of red. And that clearly was the case last year. So I'm now going to turn to actually two trades that worked well last year and one that didn't, to really try to put a little bit of flesh around how it is that these guys invest and make money. So the biggest winner in our portfolio last year was a bet that the Japanese yen would decline. So on the left axis, you can see price, and that dark line shows the movement of the yen during 2022. So the yen starts the year a little bit below 115. And by the way, that means that a dollar buys 115 yen and then declines to around 150 by early November. So remember, everything is a bit confusing in FX land, but the more yen a dollar can buy, the stronger the dollar and the weaker the yen. So the chart shows the yen getting a lot weaker. Next, to put the size of this move in context, that shaded area on the top between 105 and 112 is the rough trading range of the yen over the 5 years preceding 2021. So the thing was basically dead money for 5 years. And the good news is that we were short. By the time the yen had weakened to 115, it had broken out of the trading band and managed futures funds were betting on further decline. That shaded area on the bottom is the cumulative profit on the position. And so note how the points line up. As the yen starts to really drop in early March, DBMF starts to make money. Then there are reversals in May and July, and lo and behold, we get back some profits. But then look at what happens. There's another sharp drop heading into the fall, but we're not making money at the same rate. The gains start tapering off in September. The reason is after those sharp reversals, a typical trend following fund gets more cautious. Yes, the trajectory is there, but the model's going to prefer a steadier path. And as noted before, this is why managed futures funds generally won't go all in on equity shorts during a bear market. So we still had a position heading into a major reversal on November 10th, and you can see the spike and then the hit to our P&L, but then we essentially flatlined. After that last move, we covered the remaining short to the next rebalancing. So as the rebound in the yen continued, we actually pivoted to a slight long position. And if you squint, you can see that we made a bit of money in the most recent spike. And in fact, the yen, which soared another 5% in December, was a positive contributor performance that month. So the point that I'd like to underscore about managed futures funds is this: they are quick to get out of positions that aren't working. This means that DBMF is quick to do the same. So it's very different from humans who often hold onto positions in a white knuckle grip. And just to kind of give one example that's been on everybody's mind, if you think about Cathie Wood and ARK, she's going to live and die by the disruptive tech sword. On the contrary, managed futures funds tend to avoid long protracted drawdowns because they're willing to change. As Warren Buffett said, they will cut their weeds quickly. So along those lines, one of the big managed futures myths is about their perceived risk and volatility. In fact, the max drawdown of managed futures space since 2000 is a modest 14%, which is a fraction of equities and now quite a bit less than that of bonds. So, as the early adopters of DBMF know, the real problem with managed futures are the categories fees and single manager risk. To the next slide, please. So on this slide, it's roughly the same story with crude oil. So while normally a big move up or down in the yen is a few percent, to put it in context, crude oil is like a wild animal. Recall that in 2020, crude oil futures actually managed to go negative to the tune of about $40, and which I think we can chalk that up as another trophy on the wall of the financial weirdness of the last days of the everything bubble. But in any case, the dark line is the price of crude oil. And so as oil recovers from 2000 and starts to march upward in 2021, managed futures again went long. Then war breaks out and it goes straight up. So, I would definitely attribute that move to a bit of timing luck. But going back to this point about position sizing, managed futures funds know that crude oil is volatile. So hence they limit the position sizes. So just like in the prior slide, the green area in the bottom is the cumulative profits from the position during the year. And so, we use the same scaling for P&L as we did in the prior page, so you can get a sense of magnitude. So we were making money, but we were making less money when when crude oil was spiking 30% than when the yen was dropping 10% or so. So managed futures funds, guys, spend a lot of time thinking about risk management, and a lot of it has to do with the volatility of the underlying positions. So the short answer is that we maintained our long position throughout the first half of the year, but given these insane gyrations, we saw a gradual reduction in risk. After the big reversal kicked into gear over the summer, we dialed out of the last long position. We've had a modest exposure since then. So again, that's the goal of a good trend following model: to identify a trade early enough to participate, reduce exposure as signs emerge that a trend is fading, and then get out before the real reversal kicks into gear. Now, of course, this doesn't work on every trade. So this is, we didn't have much success with gold last year. And this is the chart with the same the performance of gold and our P&L. And so over the course of the year, we lost in aggregate about 1%. But if you take a look at the price chart, you'll see that as the war starts, gold spikes, then it reverses, then it stabilizes, then it drops, then reverses and drops, and finally ends the year flat. There might be some trend followers who focus on these very, very short windows, a week or two, and they may love this kind of volatility. But for the vast majority of the managed futures space, these whipsaws are too sharp and too frequent and directionless to give the models any comfort that the trend is going to continue. So they do what we would hope they would do. They stay away. And one thing that I really like about the space is that there are plenty of fish in the proverbial pond. So if it isn't a good time to take a view on gold, they'll pivot into better opportunities. So when you look at our P&L, you can see that our positioning generally was not zero, but it was small enough that we weren't making much or losing much on those relatively big moves. And by the way, a lot of the latter half of the 220, excuse me, a lot of the latter half of the 2010s felt like this. Prices basically oscillating back and forth, which, in general is going to be a tougher environment for these kinds of strategies. So our last slide is on positioning. So as you know, we believe that simpler portfolios are not only more efficient to trade, but also easier to understand. So one complexity, though, is that when you trade across asset classes, is that you have some positions that normally are quite steady, like currencies or short-term treasuries, and others that are wildly volatile, like crude oil. And it gets even a little more confusing when you're trading futures contracts and everything is denominated in notional value. So the way that we manage this is we look at what's called volatility adjusted exposure, which is basically a way to make these disparate asset classes more equivalent from a risk perspective. The columns here show exposures across the 10 major factors we trade. And so the columns represent our current exposure, while the red dots show where it was 3 months ago. So let's start on the left with commodities. Modestly long crude oil and short gold. Those positions have been relatively stable. As discussed regarding the yen, there have been significant rotations on the currency side. We're still short the euro, although less so than a very large position we had a few months ago. But we have pivoted to long the yen. The red dot shows we were still short, but at a reduced level about 3 months ago, in the yen, that is. Our most stable positioning has been on the rate side. We are and were short the front, middle, and back of the treasury curve. So based on positioning, managed futures funds just simply do not believe that rates are going back down anytime soon. As noted in the beginning, the treasury short has been a consistent money maker this year and has delivered about 10 points of gains. And finally, on the right side, we see equities. Right now, we're long U.S., non-U.S. developed. We're short the S&P 500 and short emerging markets. These positions do rotate around, but what they tell me is that today, managed futures expect value stocks, which are a bigger part of those non-U.S. developed markets, to outperform, and they expect the recent rally in emerging markets, i.e. China, to fade. So overall, I like the positioning. It feels like a hedge, but it also feels a bit more cautious than it was a few months ago. And so, obviously the view that the markets could go down a lot from here isn't really consensus. But, again, our macro view is that consensus has consistently been over-optimistic. So we like the idea of having more things in the portfolio that are providing hedging. So with that, let me hand the microphone back to Mike, who can make the closing remarks. And again, final thanks from me for taking the time.
Thanks, Andrew. I'll close here real quick just to say thanks to all of our clients and to our prospective clients for your confidence and your interest in DBMF. If you have more questions about the strategy, would like further information or a call with us, please don't hesitate to reach out. Just send us an email at team@imgpfunds.com. So until next time, thanks for spending time on the first of what will become regular updates like this from Andrew Beer and Dynamic Beta Investments through our team here at IM Global Partner.